今天呢，我们非常高兴能够邀请到我们施罗德投资亚洲多元资产团队的最高主管 Keiko Kondo 女士，来为大家揭晓我们2024年的10大预测。让我们用掌声欢迎 Keiko。Ladies and gentlemen, let's welcome Keiko.
Good afternoon, everyone, and thank you for joining this opportunity. It's quite unbelievable to think that it's already a year since I was standing here last time presenting 2023 top 10 prediction. It's a great honor to have this opportunity again, and I'd like to start this session by let's just look back and see where the world has been over the past 12 months and the investment environment, and also how last year's prediction did. So first, when we think about the environment that surrounded us over the past 12 months, first thing I would say is that the economy globally has been quite remarkable in the sense of how resilient the growth has been. In fact, I do recall standing a year ago saying, given how much the interest rate has moved up during 2022, the risk of recession potentially is around the corner. In fact, I do remember that a lot of the industry experts were saying that risk definitely as one of the factors to think going into 2023. Standing here, we have not seen any of the recession. In fact, the economy has been very resilient. So in terms of that economic expectation, in some ways, we didn't get that forecast right. This is not about a part of the top 10, but certainly the environment, this was not what we expected. But in the meantime, because of this environment, what we kept seeing is that the higher growth, resilient, which is a good news, of course, but also meant the higher inflation. And the topics around interest rate outlook, financial policies, these things continue to be surrounding us throughout this year. And finally, unfortunately, the geopolitical risks, which was already the topic during the 2022, continue to be around us. In fact, I personally feel that the geopolitics risk is something that will never go away, but it's almost like a tip of the iceberg where it's always there, but how much you can see on the surface is the one that really what we do see today. But certainly, we seem to be continuing to see the tip of the iceberg appearing above the water, and that environment has not changed very much. In fact, recently, there's another risk that's popping up because of the conflict in the Middle East. So that continues to be something that surrounds us. So the environment, first of all, therefore, is not really what we had anticipated to some degrees. But then in terms of then the top 10 prediction that I presented last year here, these are the top 10. How we did on this is this. So we got still 6 out of 10 right. And if I could cheat this a little bit, in fact, as we speak today, it's 7 out of 10. Because number one, which is the long inflation link bond, which when I had to prepare this slide in the middle of October, was negative. I checked the numbers as of yesterday, it's actually positive. So I do have 7 out of 10. But I would say that I'm actually reasonably pleased with this result. And in fact, this is almost how multi-asset investors think. Because obviously on the surface, if I'm standing here, if I were to be able to present, I got all 10 right, that would be brilliant. But that's not what we do as a multi-asset investor. In fact, we aim to always have 6 or 7 right out of 10. Because we believe that the world, no one has a crystal ball. We believe in diversification. If you put all the eggs in one basket, when something goes wrong, everything will go wrong. In fact, by having different things that will potentially play in the portfolios, we try to get majority right, but not necessarily everything right, because we do need to have some hedges. So this number, when I looked at this, I'm reasonably pleased. Also with those trades that did not make the positive return, I was laughing to myself, thinking I wanted to be long Japanese yen versus Asian currencies. Maybe my personal desire was a little bit too strong in that front as a Japanese. So When I look at, however, some of these trades that did not do well, actually the magnitude of negative was not as large compared to some of the very positive numbers I was able to bring from the positive trades. So in a grand scheme, I feel that at least some of the pictures, despite different environment, in fact, even if we are seeing a different kind of environment, the idea is to get some of the majority trades right, and I think that's how luckily turned out to be. And now, I guess based on this, I need to be thinking next 12 months, what that means in terms of investment opportunities. And for that, let's think about now, even though I got the call wrong, hopefully for the next 12 months, I might have some of that environment potentially defined more right this time. So let's think about the environment we are in. So I already touched on that the growth has been much more resilient than we had originally anticipated, or a lot of us had anticipated. But I would say that based on what we've seen so far and the resilience of the economy, we have learned and adjusted our expectations for the economy. We still think that the growth rate for next year will be slower than this year. However, we are no longer expecting a recession. First of all, the risk of the recession, timing-wise, has been pushed further out. It's been delayed. In addition, what we do find is that the speed of the growth slowing down will be a lot slower, but then also the bottom will be not as deep, so we will see that we are forecasting still slight negative growth in the US for the second quarter next year, but only 1 quarter of negative growth, meaning in the technical definition of recession, we are no longer expecting one, and the growth to slowly move back up. So the slope is much slower and potentially lasting longer, is what we are expecting now. And I guess this, in a world that we say often is soft landing, is really the expectations we do have. But I also think that a lot of us, just from how the economy behaved, the market also has moved very much in that direction. The expectation, consensus expectation today has also moved in that direction. And obviously, again, how different the actual economy had turned out to be. And we are sort of still in that transition phase that we are facing today. So speaking of transition, the reason that we find that sometimes the forecasts have gone, there are two fronts. And one of the big reasons is that we have potentially moved into new regime, which might look like an old regime. And what I mean by that is that the left-hand side chart here shows that the relationship of growth rate on the x-axis and the inflation on the y-axis. What it means is that the green and the purple dots, which are the 2000 and 2010s, meaning past 20 years, regardless of the growth rate, inflation was low. And that was 2 decades of, therefore, low inflation, low interest rate. 2020 onwards, it changed. Now the relationship between the growth rate and the inflation is more positively sloped, meaning that there's a trade-off between the growth and inflation, which is almost like 1990s, meaning pre-tech bubble days. So this is what I mean by new normal. Might be something, has some resemblance of old normal, which we all are too young to know, I hope. But I guess in some ways, because we have not been in an environment like this, it leaves a question of uncertainty. The right-hand side chart shows is the indicator, is a composite indicator, measures the level of uncertainties in the economy. And this indicator shows that obviously the highest peak is in 2020 during the COVID peak. Obviously, that's a different kind of uncertainty. But today, obviously, COVID is completely behind us. In fact, a year ago when I was standing here was one of the first indications of normalization. I was here, being able to stand, flying in, and meet you in person. And obviously, things have moved on. Everyone feels very normal today. But still, uncertainty is continuing on compared to the historical level. And why is that? Because we are facing the new rule books that we have to deal with. And the new rule book still is centered around inflation and growth. So where are we in terms of inflation? US economies have started to show that the gradual moderation of inflation. In fact, the CPI growth rate has peaked just about a year ago, has been moderating, but today it's still around 4. Started off from close to 6.5%, 7%, coming down. A year later, we are still 4, which is noticeably still above what the Federal Reserve Bank continues to be the target, 2%. So we have some distance. Then are we going to get there? We believe we will, but time that's required to reach there will be still some time. The reason we believe we will get there, because a lot of the indicators are continuing to move in the right direction. The right-hand side shows one of the big components of CPI that has been keeping the speed of moderation slow, which is called shelter, with a translation of rent. Obviously, the rental market in the US, certainly we started to see the moderation in the rent because the housing price, interest rate has moved up, mortgage rate has moved up, and then therefore the rent is actually starting to come down. But in some ways that we know that rent, not everyone reduced the rent at the same time. So there's a delayed effect hitting into the economy. So when we forecast out based on the new ongoing rent, we think that the shelter will continue to come down in the coming months, help bringing the CPI down. That's a good news. On the other hand, where there are still some challenges is the tightness of the labor market. So again, the left-hand chart shows how much of the aggressive tightening, financial tightening that had taken place during 22 into 23. And the financial condition, in fact, remained very tight during 23 already for months, with US mortgage rate, for example, approaching 8%. That's a much higher number than the people have been used to paying. Despite that being already multiple months, we are only just beginning to see a small pickup in the unemployment, meaning that the sensitivity to the higher interest rate that appearing is very slow. And we find that that's potentially something that caught us a bit on the, I would say, a bit surprised, how resilient the labor market and the tightness has continued. And we could see that partially there is potentially some demographic change. We are beginning to see a bit of the pickup in participation on the left-hand side, but structurally, despite all this market change, the participation never went back to pre-pandemic level. We're moving closer, but structurally the participation might end up being somewhere lower than historically we have seen. That might be something to do with demographics. That also has investment implications, but that's one picture we do find as an interesting phenomenon. But with that environment, the wages only wage increase is only coming down at the slow pace, just like inflation. But the good news is that because the wage has not come down aggressively, the good news for the economy is that because the inflation already came down, the real wage growth, when at the peak of inflation was clearly negative, now it's actually positive, meaning that the purchasing power of US consumers to some way, in a strange way, has been restored to some degree. That allows the consumption to be resilient, and that's contributing to the economy. So speaking of the consumer balance sheet, which relates to the wage and so the ability to consume, what we find interesting is that after the COVID, with all the money that was handed from the US government to consumer pockets, ended up in excess saving pickup, which were earlier estimated to be slightly less than $2 trillion. Recently we revised, in fact, was more than $2 trillion. It's more like $2.2 trillion. So there's even more money to be spent, but with the wage actually being holding up, the drawdown of this excess saving, which was one of the reasons that a lot of the economists out there used to say, well, as this excess saving gets depleted, growth will significantly slow down. But this depletion of the excess saving has not even ended. So this is where the forecast did not turn out to be in the same way as a lot of us expected. And in fact, it's likely to give us several more months at least of the spending power, which is likely to lead to potentially more resilience growth and only slow translation of the tight monetary policy into the real economic activities. So that means that we have adjusted our views in the sense that economy will slow down, but at a slower pace, and inflation stickier, again, coming down more gradually. And that sets the environment for now sort of the very common phrase that we now hear in the industry, higher for longer, meaning that the interest rate potentially remain higher for the longer period in a world where the inflation structurally may be higher than what we have been used to in the past decade or two. But is that really a bad thing for investment environment? We do not believe so. In fact, still having said that, higher interest rate, the changes in the increase of the interest rate, we've come a very long way. We are only the matter of now potentially waiting longer for the corrections to occur as needed. So the changes in the interest, which was the biggest factor for the asset price volatilities, is starting to slowly move away, go behind us. Obviously slower than we had wanted, but still definitely moving in that direction. That sets the environment to potentially thinking about where we can capture returns and seek opportunities. So let me start thinking about sort of where we think in terms of the various assets that it could be looking interesting. It took a lot of guts for me to put the lot on S&P because S&P has gone up quite massively already. And people do ask me, it's quite expensive. But we believe that S&P is a unique market or the unique index, unfortunately, because the index is very influenced by Magnificent Seven stocks, which I'm sure everyone's heard about. Therefore, the index does look expensive. But what matters to us more is beyond those 7 stocks. Because, as I touched on earlier, the labor market is very tight. Demographic is changing. Companies continue to see the shortage of workers. That means that investment to boost the productivity, we need to get more out of individual workers. In order to do that, investment in technology works. So obviously the very common buzzword these days is maybe the AI, but AI is not everything. AI is only part of it. A lot of us use AI and ChatGPT to do different works. It's become a lot more normal part of life these days, including ourselves. But we believe that the investment in technology to increase the productivity across the various industries is something that's at a very early stage. We think that's needed because the labor market is going to be tight. So with that, we think that it's not only about the 7 stocks. If that theme is true, then we believe that there should be a broadening of the companies that are more not the sort of the popularity, but really from the fundamental viewpoint, become the true driver of the growth. And US market does have a lot of companies that are more stronger in that kind of the area. And interestingly enough, when we exclude those 7 stocks, to look at the red line on the right-hand side chart, the valuations for 493 stocks in S&P are actually very reasonable. So those companies have not really benefited from this AI or technology boom. And if we think this is more of the long-term theme that's going to be around us, those are really more the opportunities that we need to be harvesting. And for that, we find still S&P is a good representation of the universe. But at the same time, we know that equity is not the only area to be generating return. So number 2 is long investment grade credit. This is, by the way, the same trade as what I had presented last year. I already had this on the screen, and this is one of the positive trade from the last year's 10 prediction. But we believe there's more to go. If we look at the dark blue line, which is the yield of the US and European investment grade corporate bonds, meaning high quality bonds, I would call this as a forest of yield or forest of carry opportunities. It's a very attractive yield that these bonds are offering, and they will give you this yield, obviously not 1 year, but multiple years, 7, 8 years. So when we look at this segment, we find that it's a very attractive opportunity to be still thinking about this, gaining access to these carry opportunities. And at the same time, because these companies are very high quality, in case the environment goes something outside of what we expect, meaning soft landing doesn't happen to be the case because no one has that perfect crystal ball. So if some potential clouds start to come in, and if we start to see some recession risk down the road, then because of high quality bond, because of the interest rate component, will also give a very nice hedge and a cushion, in fact, give even positive return in recession. So carrying, if nothing happens, it will give you very attractive carry. If something is to happen, it will give you the price appreciation opportunities. Either way, high quality credit is still a good asset class to continue owning. The third one is then when we talk about credit, people do ask me, what about high yield? It gives you even better yield than investment grade. It is very true that the high yield offers one of the very attractive yield today. But the way I try to construct this view is that high yield is attractive, but what if something goes wrong? It's also an asset class. It could be very vulnerable because interest rate portion is small, and also high yield can become quickly illiquid compared to investment grade. So by owning high yield, which gives you a very attractive carry, better than the investment grade, I will recommend selling some equities. And we have paired this with the Russell 2000, which is a small cap universe of the US equity market. Because when weather goes tougher, the sensitivity of high yield to equities go up. By having a bit of the short equities or hedging some of the high yield exposures, I calculated this based on 25%. So basically, if you buy 10 high yield, sell 2.5 equities, we think that you allow you to harvest the carry, but remove the volatilities you do not want along the way. So another way to look at this is that on a standalone basis within the credit, I prefer quality. But high yield versus a Russell is a better capital structure because bond is always, even high yield is a higher capital structure than the equity. So still going for the quality to make sure that we are still in that transition period and you don't want to be caught off guard. Number 4 is EM local currency bond. EM currencies recently have been sold off on the back of very strong US dollar. And the US dollar has been strong because the US economy has been strong and the rate expectations of US probably moved up compared to where people had expected earlier. But when we look at then yield opportunities in the EM local currency universe, it is also attractive. And also, because of the higher interest rate in the EM economies, if the conditions change in the economy that requires to be addressed, central banks in EM economies will be able to cut rates a lot quicker because they are now running with a very high interest rate. So nothing happens, EM carry, and potentially the slowly peaking of the US dollar will give you opportunity from the currency side, which had been sold off already. The reverse, if something goes wrong, you may not be necessarily gaining from the currencies, but the local bond side, where then the interest rate can move down, will actually offers a safety. So when we put that in together, the different levers together will make the EM as an interesting opportunities. So far, a lot of these positions I have presented are still very much of putting the risk back into the portfolio. So do I, as a multi-asset investor, I feel, is that too much? Do I need some hedge? And one of the trade that we find is buying gold could be interesting. Unfortunately, gold in the past few weeks have moved up aggressively because of the Middle East conflict. When we were just putting this together a month ago, obviously the gold was at a lot better level. But it also shows that how this gold as an asset class has a very unique characteristics, once again, of the hedge against geopolitics and also potentially good hedge against recession. So in that sense, we find that gold, if we could find potentially some weakness in the upcoming weeks or months, when the geopolitics factor gets a little bit less focused in the market and buying on the weakness, still could be interesting because outside of geopolitics, gold behaves together with real yield, meaning that when the real yield starts to decline, gold appreciates. The flip side relation is actually looser. When the real yield moves up, gold can be in either direction, drives its other factors. But when the real yield falls, which we believe as we start to see moderation of growth to take place, then we will see the gold appreciating. So it's a appreciation potential, but also as excellent hedging characteristics that gold brings as asset class. But please buy on the weakness because it's just rallied. So those are sort of the 5 key asset class views that I like to present. But then let's take a different stance and say, what about the markets that are close to us? Are there opportunities in Asia? This year, unfortunately, Asia has been still struggling on a relative basis versus the global financial markets. Currencies have been weak. Equities have been underperforming the global markets. But we think that potentially the environment might be changing. The reason we say that is that when we look at the EM or Asian equity markets, there are 2 drivers, China and Asian exporters. China's recovery story, which everyone was excited a year ago, unfortunately turned out to be much slower progression. It's been a disappointment in a sense of the speed of recovery. Export side, this is where it's kind of interesting, because I know I said at the start that we didn't get the recession call right. And the recession call that a lot of the economists, including ours, made were largely based on the indicators that are linked to manufacturing sectors. So manufacturing sector, in fact, over the past year, had gone through pretty much like a recession-like environment. You can see that, I'm sure you see that potentially from some of the export-linked economy here, but we saw that the export growth was deeply negative. Therefore, these Asian export economies did not benefit from the recovery yet. In fact, went through some of the tough time. But what we do see is that these indicators are starting to turn. In fact, the reason that we are now adjusting our economic view even for the US, saying slower growth moderation, is because the service sector will moderate, but potentially manufacturing that have actually corrected already and went through recession-like behavior will start to come back up. Which is quite unusual because historically 2 always move in parallel. But this cycle, because of maybe COVID, the path of the manufacturing and non-manufacturing economies moved apart so far that we did not forecast. So if we are learning from that, the reverse force will continue to take then in upcoming months, service declining gradually, manufacturing recovering gradually. We know that from the past experience, obviously service, especially for the US, is a larger part of the economy. Therefore, the grand scheme of things will moderate. But if we look at the Asian exporters' economy, we think that they are more likely to benefit in going forward. So that does present some opportunities. And I did touch on China. China factor is a big question mark. I think everyone knows the Chinese equity is probably one of the most undervalued market today, outside of the other idea I will be presenting later. But I guess the lack of conviction in international investor base to go back into China has made it higher and higher hurdles for the Chinese equities market to go back into the bull market. Therefore, we think that the first recovery will be definitely more around the exporters. But then the China factor is potential extra benefit that may or may not deliver. And to navigate that risk better, we have then pair the Asian equities versus the European equities. Because Europe has a similar factor in terms of being exposed to China. What they have different from Asia is the European economy, which had been doing well, but beginning to actually weaken quite noticeably recently. So the domestic side of the European economy is now starting to face more challenges. In the meantime, the China factors between the Asian market and European market does offset with each other. So this makes the trade to be a lot more directly benefiting from the export-oriented cycle. So that's what I'm looking for from this trade. And a similar theme can be found in the currencies. In the last year's pairing, I went long yen versus Asian currencies, my personal wish to see the yen strengthen. Both yen and Asian currencies weakened together. So I did not get the trade right, but both weakened. But that makes the Asian currencies quite attractive. And as the US interest rate starts to come down, or at least peak out, and the Asian fundamental export-related started to bottom out and then improve, we think that the Asian currencies has a chance to then coming back and start to gain versus dollar. So I've put the Asian currencies long this time instead of short as last time. And together with Asian currencies, I'd like to try one more time being long yen, but versus euro. I think the yen is definitely one factor. Last time we thought that all the Asian currencies are weak, and the weakest of all was yen. So the last year's trade was actually trying to play within Asia. This year, we believe that both yen and Asian currencies that had weakened more so actually does bring the opportunity. Why do I pick yen versus euro? It's because of the central bank policy difference. So recently, I'm sure many of you have been following that the Bank of Japan has changed in a few sequence the yield curve control policy. It's still there, but personally I consider that to be practically being removed, de facto just moving in the direction to remove that control. What we are then waiting for is the policy rate, which has been 0% as far as I can remember for a very long time, potentially to start moving up. And that can take place only after BOJ feels comfortable about the wage increases in Japan, which is likely to be confirmed probably in the spring next year. So that gives a window for BOJ to take the further step, and that we believe it will be a flood in terms of the view on yen that's going to be reversing the flow. In the meantime, as I mentioned already earlier, European economies, which you can see from the blue line, the light blue line, which is the manufacturing for Germany, and the light green line is the service sector for Germany. You can see that the European economy is weaker than Japan and weaker than the US, meaning that the central banks in Europe is likely, ECB is likely to be cutting rates sooner than the US. So the interest rate differential, which drives the currency, is likely to be one of the earlier one to be shrinking rather than others. So this is why the yen versus euro starts to look interesting to us. So opportunities certainly from the asset class, and more opportunities definitely, hopefully, for next year, also from Asian markets. But then I'd like to take then a different approach and say, but we also need to think about potentially the themes that will last even beyond 1 year. And we started introducing some of that always in this top prediction, but we also like to bring two this year as well. So the last two, the first one is clean energy. It was quite interesting. I was actually quite pleased to see the poll result where everyone was talking about important to think about decarbonization, ESG, clean energy, wind, all these sort of the clean energy is definitely the theme that it cannot go away. In fact, it's a long-lasting theme. Unfortunately, we thought the clean energy was already quite cheap last year. This is one of the trades actually did not make money over the past 12 months. That was on the list. Because we thought the valuations, as you can see on the right-hand side, the dark blue line, a year ago was already pretty attractive in terms of valuation. Unfortunately, it corrected more and got even cheaper. But we know that the drivers of this investment is something that everyone has very close to heart, everyone's heart. And I think that is something that we do find interesting. And the behavior of these stocks are very much linked to real yield, just like we talked about in gold. So we think that because the economy will start to grow slower in coming months, that will allow the real yield to be starting to fall. That sets down the environment for the clean energies to make the comeback because of that tight relationship. So it is something that we are finding as a deep value opportunities, almost just like Chinese equities. But between the deep value opportunities, that long-term sustainable story of the clean energy to us is more convincing beyond sort of the whatever the time frame we look at. Therefore, I have chosen this as a deep value opportunity. And I think that definitely then relates to how can we then access also something that goes beyond sort of the traditional way of thinking. So the last one I have then added is the trade that we had last year was long alternatives. I have narrowed down a little bit more this year to say just private assets. I'm not necessarily saying that the other alternatives are no longer attractive, but the private asset, given how we learned that the economic outcome is so difficult to be forecasted with a precision. And we are continuing to be surrounded by, unfortunately, the volatility and uncertainties. The private asset is an asset class that we find very unique in the sense that it is priced based on the valuations, not about the daily market pricing, but offers very fundamental stories behind it. And when we look at the valuation of the private assets in general, they're not necessarily saying screamingly cheap. They are still fair. We believe the valuation of private assets are generally fair. But then we also know that the private assets do offer return with lower volatility. So when we think about the trade-off or the reward for one unit of risk, private asset does look still very, very attractive and behaves differently from the rest of the market, meaning that the diversification benefit is great. So private asset space certainly to us looks like an interesting area. And also it's an area that if you are to invest in this asset class, it's not about buying and then selling 3 months or 5 months later. This is an asset class you invest and hold for multiple years. But obviously if you're going to be holding multiple years, your entry level matters. So when we look at the valuation of the asset class in general for the private assets, we still think that the market is fairly priced, allowing you still to enjoy or to enter into the multi-year journey. So we believe that the private assets is definitely the space to do find interesting. So those are the top 10 predictions, and I have put them in the order that I presented just now. And I hope that I will be here a year from now and be able to say at least 6, possibly the best number will be 7 out of 10 instead. We've done well, but I hope to be able to come back to you with that face 12 months from now. So thank you very much.
好，谢谢，让我们再次用掌声谢谢 Keiko 为我们带来这么精辟的分享哦。